It does take us to our talk of the tape, whether this bull market has run off the road just as earnings season gets going. Let's ask our panel. Bryn Talkington of Requisite Capital, CNBC contributor, Avery Sheffield, co-founder and CIO of VantageRock. She and our senior markets commentator, Mike Santoli, are here with me on set. It's good to have you with us today. Avery, I begin with you. Did anything meaningful change this week for the bulls?
I think the bulls began to recognize that, you can't have your cake and eat it too, right? So the market has been looking for lower unemployment, lower costs, lower rates, lower inflation, and at the same time, looking for growth enabled by higher wages, higher prices, and higher government spending. And the reality is the last part of that's coming to reality or continuing, and that means inflation's higher for longer, and it kind of makes it harder to have these low rates continue to have low rates come soon enough to stimulate the economy for the next leg up.
Should we be less bullish than we were? Did the game change in some respects this week because of the inflation reads that we got? Yes.
Well, I think that the bulls have gotten ahead of themselves, right? Valuations have been expanding. If year over year valuations are up 25%, while earnings estimates are actually about flat. And even over the past several months, you've continued to have valuation expansion with going from the expectation of rate cuts to nearly 6 to under 2. So, something needs to give. And, I think it's the markets that are giving. And then you add on to that, increased geopolitical risks. And it's a tougher environment.
OK, Bryn, you want to tell me what the takeaway is thus far for what's been a pretty turbulent week?
Yeah, I think as the week started, we're ending. I think it's definitely going to be risk off. We don't want to see Iran and Israel get into any type of skirmish. And I think that's also, gold's down a little bit today, but gold's had a huge run. And so I think people are putting their hedges on. And I think, in addition, it's like we started the year, Scott, with 6 rate cuts and an AI euphoria. I think AI is getting a little bit tired consolidating, and we're going to now have maybe 1 cut in December or what have you. And so I just think the market's repricing. But I think today specifically is more geopolitical as well as yields going higher.
These are good points that are being made, Mike, in that if you were really bullish months ago on the idea that you're going to get rate cuts, and that was going to be a principal part of the story, how can you possibly be as bullish today on the idea you're going to get fewer?
It's more complicated. We were operating on the premise that we might not have to make painful trade-offs and give up the idea of the Fed easing into record high stock market, 3% GDP economies. So that's something I've been saying for a while. I do look at it a little bit more about the atmospheric conditions that preceded this moment, which is the market straight up for 5 months, no 2% pullback in the S&P 500, a very tight clustering of the consensus around the soft or no landing, and yet we're going to have the Fed cut and yields are going to stay tame and all of that. So I think we've gotten a pretty welcome shakeup of that opinion. And so if you had more, you have to have less conviction now in any of those views than you did 2 weeks ago. That being said, I'm not going to get too overexcited about a 0.02 of a percentage point, upside in CPI month over month that all of a sudden tears up the entire premise of how we got here. PCE is going to be under 3% annualized coming up in 2 weeks. And you're going to be able to kind of make both cases for a little while here that the economy's fine. Earnings are going to be better than expected in the first quarter, even if they're just getting back to what we thought they were going to be 3 months ago. And so we're less than 3% from the highs. We had our first 50-day moving average test in the S&P, again, in 5 months. That was a really long stretch. So I think you've lost the momentum players. That's broken. I think that you've lost the valuation doesn't matter because we're going to get rate cuts camp. And what you have to do is have a fresh eyes on valuation relative to earnings and also the big secular themes. Because every time we think this market is getting a macro gut check, somebody says AI and three mega caps go flying. And all of a sudden we think it's back to happy days again.